USA Rare Earth, ticker symbol USAR, missed Q2 2026 top-line consensus by a wide margin. Revenue came in at exactly $5.82 million against the street's $8.000 million expectation.
Right, so that is a 27.25% miss on the top line.
Exactly. Adjusted earnings per share, though, matched consensus perfectly at a loss of 15 cents per share.
But the balance sheet and the forward guidance, they tell a much heavier story here. The company reported a massive $1.53 billion cash position.
Which is huge.
Oh, absolutely huge. That liquidity was heavily fortified by a recent PIPE financing. For those tracking the capital structure, that's a private investment in public equity, meaning institutional players bought a massive block of stock directly from the company to pad those reserves.
Right.
And furthermore, they officially unlocked up to $1.6 billion in TRIP MPS Act funding capacity. That breaks down into $277 million in direct federal grants and a $1.3 billion loan guarantee.
And on the operational front, management guided that domestic magnet manufacturing at their Stillwater facility that remains perfectly on track for a 600 metric ton run rate by the end of this year.
Yeah, but the market took no prisoners.
None at all. Investors brutally punished that top-line miss. Shares slipped 1.5% during the regular trading session to close at 19.04.
Yeah.
But the real damage hit after the bell. The stock plunged another 9.03% in after-hours trading, dropping all the way down to 17.32.
It was a bloodbath.
It really was. And you sent us a massive stack of sources on this USR's actual Q2 earnings report, the sell-side analyst notes trying to make sense of the sell-off, and some deep-dive geopolitical op-eds framing the company's broader macro strategy.
Because there's a lot to untangle here.
Exactly. Our mission today for this deep dive is to figure out if this company is setting up a catastrophic ticking time bomb of retail equity dilution, or if it is quietly transforming into, the most important critical defense stock of the next decade.
Right.
Okay, let's unpack this. Because if you were looking at your portfolio right now and sweating that 9% after-hours drop, you really have to separate the headline noise from the actual business model.
You do?
Look at USA Rare Earth's current financial profile. To me, this looks exactly like an early-stage biotech firm.
Oh, that's an interesting way to look at it.
Right. You've got a massive cash runway, you have high cash burn as you build out your foundational infrastructure, and your valuation is entirely dependent on future commercialization, not current quarterly sales.
Yeah, that makes sense.
In biotech, you wouldn't punish a pre-revenue company for a phase 2 clinical trial not generating retail sales. So why is the market punishing a pre-commercial critical minerals operator for an early-stage revenue miss of just $2 million? Especially when their cash position is heavily fortified at $1.5 billion.
Well, the biotech analogy gets you halfway there, but it's actually it's more dangerous than that, and I think it explains the severity of the sell-off.
How so?
In biotech, the FDA approval timeline is a binary event. It is a rigid yes or no gate. But in heavy industrial materials and mining, the timeline for commercial ramp-up is a messy, bleeding cash spectrum.
Oh, for sure.
The market is hyper-focused on one specific metric right now, and that's velocity. How quickly can operations convert from just, moving dirt to actual recognized sales?
Right, because cash is burning every single day.
Exactly. The market essentially priced in a steeper, faster revenue curve for this quarter. When a company carrying a multi-billion-dollar valuation misses an $8 million revenue target, it triggers an immediate crisis of confidence regarding their execution speed.
I see.
Yeah, investors aren't panicking over the missing $2 million. They are panicking over what that miss implies about the timeline of the whole operation.
So to understand why the market panicked over what is essentially a rounding error in their overall capital stack, we have to look under the hood at the segment performance and the margin profile. The devil is entirely in the details of the cash flow here. Where did that $5.82 million actually come from?
It came entirely from overseas.
Wait, all of it?
All of it. 100% of that $5.82 million in revenue was generated by their less common metals, or LCM alloy business located in the United Kingdom. The domestic U.S. magnet operations, which, let's be honest, is the core thesis for almost every retail investor holding this stock-generated absolute zero in revenue.
Zero.
Now, operationally, they did hit a major milestone. They achieved their first commercial production of yttrium metal.
Which is a massive technical feat given the complex chemistry involved.
It is. It really is. But the physical reality is that actual domestic magnet sales won't commence until late 2026.
And while that modest revenue is trickling in from the UK operations, the cash burn here at home is just a raging bonfire. I mean, the gross loss alone was 1.58 million. Operating expenses ballooned to 45 million for the quarter.
It's a huge jump.
It drove a massive operating loss of 46.3 million. But if you just glance at the headline net loss in the press release, it looked, well, artificially favorable. It was reported at just 10.3 million, or a loss of 5 cents a share.
Yeah, which looks great on paper.
Right. If you're an investor just scanning the headlines, a 5-cent loss looks like management is heavily controlling costs.
Which is entirely deceptive. That reported net loss was heavily skewed by corporate accounting mechanics. Specifically, they recorded a $22.4 million non-cash fair value gain on warrant and earnout liabilities.
Let me stop you there because we shouldn't gloss over the accounting magic here.
Go for it.
Essentially, because the company's stock price and valuation metrics fluctuated downward during the quarter, the calculated future costs of paying out their issued warrants dropped.
Right.
So accounting rules let them record that drop in future liability as a quote-unquote gain on the current income statement, even though not a single actual dollar entered their bank account.
Exactly.
I mean, I wish I could tell my credit card company I had a bad month at work, so my debt is technically cheaper on paper, and therefore I'm recording a personal gain. It is absolute paper magic.
It really is, and it obscures the physical cash burn of the operation. To see how the business is actually performing, you have to strip away those non-cash adjustments.
Okay, so what's the real number?
When you pull that $22 million out of the equation, the adjusted net loss was $33.5 million. That is your true indicator of the quarterly burn rate required to keep this massive multi-continent project moving forward.
Wow.
They are burning over $10 million a month just to keep the lights on and the construction moving.
And that leads me to a very pointed question for you, and honestly for the analysts modeling this stock. The company practically telegraphed that domestic magnet sales wouldn't start until the end of 2026. Management has been wide open about the construction timeline for the Stillwater facility.
They have.
So if we all knew the physical magnets weren't rolling off the assembly line yet, why were sell-side analysts modeling for $8 million in Q2? Were Wall Street expectations fundamentally disconnected from the company's actual operational timeline?
What's fascinating here is the fundamental misunderstanding by equity analysts of how industrial sales actually work in this specific, highly technical sector.
Okay, break that down.
Wall Street analysts look at the memorandums of understanding, the MOUs, that USA Rare Earth has signed with major manufacturers, and they model a linear rapid conversion.
Like it's a software subscription or something.
Exactly. They assume an MOU turns into a binding purchase order and then straight into quarterly revenue within weeks. But that is simply not how heavy rare earths work. The qualification cycles for these materials take months and frequently over a year.
Because of the testing.
Right. Customers right now are testing dysprosium and NdPr oxide samples produced by USA Rare Earth. A defense contractor building missile guidance systems or an EV manufacturer building drivetrains, they don't just sign a contract and start buying tons of magnet material off the lot.
They can't afford to get it wrong.
No. They have to test those specific oxide samples for thermal stability. They have to test for magnetic degradation under extreme stress. They demand batch-to-batch consistency over a prolonged period.
So the $8 million consensus was just fantasy.
The $8 million consensus likely assumed a much faster conversion of MOUs into binding POs than the physical reality of rigorous materials testing actually permitted. Wall Street basically modeled a software sales cycle onto a heavy industrials reality.
So the analysts got ahead of their skis. But to justify this incredible quarterly cash burn, and let's remind ourselves, we're talking $45 million in OPEX and another $66 million in CAPEX. This quarter, alone management is leaning incredibly hard into a larger macro thesis.
A very ambitious one.
They are betting the entire future of the company on the geopolitical fracturing of the rare earth market.
Yeah, that geopolitical fracture is the defining narrative of the company right now.
Yeah.
Barbara Humpton, the CEO, who, by the way, is retiring on October 1st and handing the reins over to Thras Moraitis, she stated plainly on the earnings call that availability or lack thereof is what governs the rare earth industry now.
Which is a stark way to put it.
It is. We are seeing the Chinese government implement strict, targeted export restrictions on processing technology and the actual physical rare earth elements.
So that changes everything.
It changes the entire pricing model. This policy shift has essentially cleaved the global market in two. You no longer have a single unified global price for these materials. You have a two-tier market, a China tier and a non-China tier. And they're operating in entirely different economic realities.
The price divergence that management highlighted to justify their strategy is absolutely staggering. Listen to these numbers. Western prices for dysprosium oxide are up over 90% in 2026 alone, trading at nearly $2,000 per kilogram.
Which is insane.
That is 9 times the price of the exact same material inside China. Yttrium oxide is up 60% this year, and it is trading at an unbelievable 200 times the Chinese domestic price.
200 times.
Here's where it gets really interesting. I look at this pricing dynamic, and it reminds me of buying a portable generator during a Category 5 hurricane.
Oh, that's a great comparison.
Right. Under normal sunny circumstances, you might shop around, compare prices online, maybe wait for a holiday sale. But when the power is out, your basement is flooding and the storm is raging. Or in the case of an automaker, when your entire multi-billion-dollar EV production line halts because you can't source magnets due to a sudden export restriction, price elasticity completely disappears.
You'll pay whatever it takes.
Exactly. You don't care if the generator costs 9 times more than it did last week. You just need it right now. Industrial buyers are no longer paying for the physical metal. They are paying whatever premium is required for the absolute security of supply.
That hurricane psychology is exactly what is driving the non-China tier right now. Buyers are terrified of a single point of failure in their supply chain. And we need to point out that half of all rare earth demand isn't even magnetic.
Really? Half?
Yeah, half. It's demand for the raw elements themselves, which are heavily used in chemical catalysts, advanced semiconductors, and vital defense systems. The reason USA Rare Earth is burning through so much capital and running that $45 million OPEX is that they are refusing to just be a mining company.
Because mining isn't enough anymore.
Humpton explicitly said on the call, a mine without processing is a stranded asset. Processing without metal and alloy-making capability is a science project.
Wow.
If you just mine the ore, you still have to ship it to China to be processed, which defeats the entire purpose of supply chain security. So they are building a fully vertical, fully enclosed supply chain.
From dirt to magnet.
Exactly. They want to own the mine, the chemical processing facilities, the metal-making plants, and the final magnet manufacturing. They're constructing this massive footprint specifically to capture those extreme Western price premiums at every single step of the value chain. That strategic ambition is what explains their hyper-aggressive capital deployment.
But building that non-China vertical chain isn't happening organically. I mean, they aren't just slowly growing this business year over year, hiring engineers and building one plant at a time. They are brute forcing this vertical integration through aggressive, high-risk mergers and acquisitions.
They're buying their way in.
Right. And that M&A spree is exactly what is inflating those operating costs. They are buying the missing links of their chain, and it is not cheap.
Let's look at the sheer scale of the acquisition spree they are currently digesting.
Yeah.
The absolute crown jewel of this strategy is the Serra Verde deal.
Oh, man, this deal.
This is a massive, proposed $2.83 billion acquisition. They are paying $300 million in cold hard cash and issuing 126.8 million shares to acquire this Brazilian heavy rare earth mine.
That is a lot of shares.
It's massive.
Mhm.
But the strategic value here is critical. Brazil offers a friendly geopolitical jurisdiction with massive reserves of heavy rare earths, diversifying them away from a pure reliance on North American geology.
Right, de-risking the geography.
Crucially, this acquisition comes with a 15-year, 100% offtake agreement that features built-in price floors. That guarantees a permanent, paying home for the product, insulating them against sudden price crashes.
Okay, what else?
Then you look domestically at TMRC. They just closed a $73.9 million all-stock deal to gain 100% economic ownership of the Round Top heavy rare earth project in Texas, streamlining their domestic supply.
Another stock deal.
Yep, and they aren't stopping at mining. They announced a $45.7 million cash and equity investment to take a 13.6% stake in Carester, a French processing specialist.
Why France?
That deal brings essential intellectual property and processing expertise into the fold, which is vital because separating these elements requires incredibly complex proprietary chemical engineering.
Okay, but this brings us to the elephant in the room, the funding. We mentioned the $1.6 billion from the Department of Commerce under the GPS Act. At first glance, that sounds like a golden ticket, a massive federal win that de-risks the whole operation.
It sounds great.
But when you read the fine print in the sources, it is a total catch-22. That money has severe strings attached. It is entirely milestone dependent.
Which means they don't just get a blank check.
Exactly. To actually unlock that 1.6 billion in direct funding and loan guarantees, the government mandates that USA Rare Earth must raise an additional 375 million in private capital by March of 2027.
Yeah, it's coming up fast.
And then they have to raise another 875 million by December of 2027. The government wants to see private skin in the game before they hand over taxpayer dollars. On top of that, just as a condition precedent to get the deal signed in the first place, USR already had to issue 16.1 million shares and 17.6 million warrants directly to the Department of Commerce.
Wow.
So what does this all mean? I have to directly challenge this capital structure. Between the 126.8 million new shares being printed out of thin air for the Serra Verde acquisition, the all-stock deal for TMRC, the millions of shares and warrants handed to the Commerce Department, and the strict mandate to raise over 1.2 billion in new capital over the next 18 months.
It's a mountain of paper.
Is USA Rare Earth building a vital industrial powerhouse at the cost of catastrophic, permanent equity dilution for their current retail investors?
If we connect this to the bigger picture, you've just articulated the ultimate execution risk that is currently haunting this stock and driving that after-hours sell-off.
The market sees the dilution coming.
They absolutely see it. The dream is necessary, but the mechanics of achieving it are treacherous. Yes, the company has an incredibly strong cushion with $1.53 billion in cash sitting on the balance sheet today, but managing post-merger integration across distinct operations in North America, South America, and Europe is hard enough in a stable environment.
Let alone right now.
Doing it while simultaneously racing the clock to meet these massive, federally mandated HHP Act's capital raise milestones is incredibly complex. If the broader equity markets take a downturn next year, or if interest rates spike again, raising that mandated $1.2 billion could require issuing new shares at highly unfavorable, depressed prices.
Which would just crush current shareholders.
It would severely dilute them, reducing their slice of the eventual profits to just a sliver. It's highly illustrative to note that the sell-side analyst community remains universally buy-rated on the stock.
Of course they are.
Wall Street is entirely focused on the long-term geopolitical tailwinds and the government backing. But that massive dilution overhang, the true underlying cost of brute forcing this vertical integration, is exactly what the retail market was digesting when they sent the stock down 9%. The market is actively weighing the ultimate value of a secure supply chain against the sheer staggering number of shares it will take to finance it.
Which leaves us looking at a company that is undeniably vital to Western national interest, but incredibly difficult to value using traditional retail metrics. When physical supply chain security is literally becoming a matter of national defense, all the old rules seem to warp.
They do. And here's a final thought for you to mull over that wasn't explicitly modeled in any of these earnings reports or analyst notes.
Let's hear it.
If USA Rare Earth actually succeeds, if they navigate the dilution, integrate the acquisitions, and build a fully independent non-China supply chain by 2027, what is the geopolitical counterattack?
Oh, wow.
What stops China from temporarily lifting their export bans, flooding the global market with deeply subsidized, artificially cheap rare earth materials, and collapsing the price?
They could wipe them out.
They could effectively bankrupt USA Rare Earth's Western operations before the Stillwater facility even reaches its 600-ton commercial maturity. You have to ask yourself if USR is simply competing against other mining companies, or if they are in a direct existential standoff with a sovereign superpower's economic policy.
A fascinating and a slightly terrifying pivot point for the company and the industry at large. Thank you for joining us for this deep dive into the numbers, the narrative, and the geopolitical chessboard. If you want to stay ahead of the market and untangle these complex balance sheets, make sure you follow the show for our daily, no-nonsense earnings coverage. See you next time.